Hello, everyone. Thank you for joining us today for our Insurance 101 webinar, Understanding Insurance for Solar Installers. Just a few quick notes before we get started. During the webinar, all attendees will be muted for best audio quality. If you have any questions throughout the presentation, feel free to use the Q&A button at the bottom of your screen to type in your questions. These will be monitored. It is my pleasure to introduce today's presenter, Jen Aitchison. Jen is a renewable energy practice leader at Hub International, bringing over 20 years of expertise as an insurance broker and risk manager dedicated to the renewables industry, with a particular focus on solar and battery storage systems. Jen, without further ado, I'll pass it over to you to get us started. Thank you.
Thanks so much for having me today, Tatum. Hi, everyone. I'm excited to chat with you about insurance today. I am the practice leader for renewable energy at Hub International. And just as a way of intro, Hub International is a North American insurance brokerage with a focus on specializations in insurance placements. And one of those specializations is renewable energy. And today, I'm going to talk to you about insurance for solar systems. We will focus the majority of this presentation on the installation risk, as I understand that most of the attendees will be focused on the installation side of the business and less on operational, but we do get into both sides of the business. So just to level set, I wanted to share some key coverages. When we look at the operational side, although this will be pretty well it on the operational side, it's all risks property, business interruption, which is loss of revenue, and commercial general liability. These are the three core coverages on the operational side. And then in the course of construction, it's very similar in that you have property, which is usually installation floater or builder's risk. We have delay in startup, which is only available under builder's risk, and that is for loss of revenue, so similar to business interruption. Liability coverage, as you'd expect, which is generally a commercial general liability or wrap-up policy. And there are some additional specialty lines. We will touch on some of those today. Professional liability, also known as errors and omissions, surety bonds, and warranty or performance guarantee coverage. So the first thing I want to touch on from a construction perspective is property. So most smaller installers typically will carry an installation floater, and this is to cover the contractor's portion of the property while it's being installed only. It typically also relies on certificates of insurance from all subcontractors, so an installation floater will only cover the property in the course of construction by the company that's currently installing it. It's typically settled on an actual cash value as opposed to replacement cost, which means there can be some deduction for depreciation if you've got installations that take some time. Typically well suited for smaller contractors doing residential installations and no subtrades, or just smaller commercial and industrial installations, and again, typically with no subtrades. A builder's risk, on the other hand, is typically what we see placed for either larger to mid-size installations, ground mount and roof mount both. Typically, it covers all contractors and subcontractors to the project until it is financially or finally completed and contractually accepted by the owner. A builder's risk is settled on replacement costs as opposed to actual cash value, so there is no deduction for any depreciation. The only time that that typically can come into play is if you've got installations that take longer, in that there could be some depreciation, although we may have hit the bottom. I think Charge will probably tell us though at some point if we've hit the bottom of the pricing for some of those components. The other piece that's only available under builder's risk is the delay in startup. So I mentioned previously loss of revenue coverage available within the course of construction. This is typically referred to as delay in startup, but it's only available under a builder's risk and not available in conjunction with an installation floater. And this is typically covering loss of revenue or loss of profit because of delays in the installation of a project that arise from a covered loss, which is really important. So this coverage isn't triggered by shipments being delayed. It's not because you can't get product or because the labor pool isn't consistent enough. It's only if there's a loss that is suffered that is covered under the builder's all risk. So property policy has to respond first. And generally, it's critical for any projects that have PPA timelines, or if you're in Ontario and you're looking to participate in global adjustment, having that loss of revenue and delay in startup is really critical as a coverage line. Some more of the key differences under either the installation or the builder's risk, you can get coverage for on-site and in transit. Typically, it ceases upon substantial completion or final acceptance by the owner, or, and this is key, if it's left unattended for 30 days. So, in the event that you have a project that perhaps you've completed most of the project, but you're waiting for a key item that has been delayed in shipment, you can extend that 30-day period, but you do have to notify your insurer. If you don't notify the insurer, the coverage may cease and you may find yourself with no coverage. We have certainly seen losses where things have been left unattended for, 30 days while waiting for something to come in to do final completion, or if there's a delay in the utility doing their final interconnection. Just some things to keep in mind. The installation floater, as I mentioned, is settled on actual cash value, and the party is the only the contractor. So if you're using subcontractors, you either have or should, I should say, should carry a builder's risk so that it covers everybody, or make sure that you're getting certificates of insurance from your subcontractors and that they're carrying their own installation floater to cover property while they're working on it. And delay in startup is not available under an installation floater scenario. When we're looking at a builder's risk, the settlement is replacement cost. It covers all parties to the project. I mean, they must be named on the policy, or you must ensure that the language of the named insured includes all parties to the project, including general contractors, subcontractors, engineers, owners, lenders, all of them to be covered within that policy. No reliance on making sure that your subcontractors have their own coverage. They are covered under that umbrella of a builder's risk. And delay in startup is an additional add-on. It also can include testing and commissioning, which is an important portion of coverage. In the event that something happens at the end when you're testing and commissioning, you want to make sure that there is coverage for the equipment breakdown piece. We typically recommend builder's risk if you have larger projects and there's multiple subtrades to manage. It can be very frustrating and challenging to deal with subtrades and making sure that all those certificates of insurance line up. If there's any renewals of those insurances that happen throughout the project, you need to make sure that you're on top of getting those certificates of insurance from them. And all of the additional insured or lost payee language is included as required by the main contracts in the project. Getting into the liability side of things, commercial general liability is to third party coverage. So bodily injury or property damage to a third party that arises out of either occupancy or installation exposure. So think if you're hauling a solar panel up onto a rooftop, it blows off and it hits a car. That's third party property damage. And so liability policy would respond to something like that. General liability is typically used when there's no subcontractor. So similar to an installation floater, it just covers the contractor for the contractor's work. It does not include additional coverage for subcontractors, even small subs that are doing things like installing a fast fence or something. The coverage does not extend to cover those subcontractors in any way, shape, or form. And so if you're using subs and you're not carrying a wrap-up liability policy, you want to make sure that you're getting certificates of insurance from all your subcontractors and that your firm is added as additional insured to their liability policy to cover any vicarious liability that you may encounter with your subs. So if your subs cause a loss, and your contract is, say, with the building owner would sue you for those damages. And if you didn't cause those damages, you would need to pull the insurance from your subcontractor. As long as you have a certificate of insurance and you're added as additional insured, even if the subcontractor does not respond, and we've seen these things play out a few years after an installation has occurred, if you have a certificate of insurance and a contract that requires these things, then you can go directly through the contractor or around the contractor and and take hold of the benefit of the insurance policy that they put into place as long as you're an additional insured and those contracts line up to reflect that. Making sure there's adequate limits as well on those commercial general liability policies is really key. It shouldn't reflect the work being done and the cost of the work being done is something we see often where folks will try and size a limit of liability based on their fees or based on their percentage of contribution to the work. But the reality is that that limit may not be sufficient. Oftentimes, the cost of the work is completely outsized to the potential exposure for liability. Getting into wrap-up liability, which is where it's a big difference from the commercial general liability in that it covers generally a specific project or a specific series of projects, similar to a builder's risk, where you are including all the subcontractors to the project. And then you're not relying on individual trade limits. It's also typically used for large multi-trade projects and often is required by contract, either by lenders or building owners, depending on what type of projects that you're getting into. As we start to see larger and larger rooftop installations, we're starting to see more use of the wrap-up liability policy across those types of installations, unless in the rare instances where there aren't any subtrades being used, except for perhaps engineering doing structural and then making sure that they carry their own insurance. The other piece from a wrap-up liability policy is that you're looking to extend the coverage beyond the final completion date. We can typically place up to a 36-month completed operations period, although the average is 24 months. And this is critical protection against deficiency claims that can emerge well after handover from a completed operations perspective. Couple of key concepts that I wanted to highlight, just so that everybody can understand how some of these things work. Joint and several liability is allowing a plaintiff to sue one or more defendants for the full damage amount, regardless of proportional fault. So remember when I mentioned that you want to right size the limit of liability based on exposure, not based on the fees. It doesn't really matter, how or how it settles out. When there's significant risk, um, the courts will tend to go for the deepest pockets. And so a plaintiff can sue everybody that's party to the project, and each of them can have their own limits attacked for that. So making sure that everyone's got sufficient limits is really important in this particular case. Vicarious liability, that's where, in the event that you have a subtrade that's working on a piece of equipment, maybe they're installing inverters, or maybe you've got laborers that are coming and putting on solar panels to racking. In the event that you're the main and you've got some labor coming in, vicarious liability is when you as the contractor can be held liable for a subcontractor's work. So if in the instance where the solar panel flies off the roof and damages a vehicle, if it's a subcontractor that has done that, you have vicarious liability because you hold the main contract. So getting yourselves as additional insured on their subcontractor policies is key to make sure that you have adequate protection, or your policy will be pulled in and may or may not respond depending on how the coverage is written. And then looking at the additional insured versus named insured, oftentimes in contracts we see these terms interchanged incorrectly. Named insured is important to note. The named insured is, if you're a contractor and you hold a policy and you're the company that is doing the work, then you would be the named insured under the policy. You can cancel a policy, you can make changes to the policy, and you're responsible for paying the premium of a policy. Additional insured only carries rights for vicarious liability. And so you can see where subcontractors have to add you as an additional insured, where you as a contractor would have to add the counterparty, whether it's a building owner or developer. as additional insured for your vicarious liability, but it doesn't give, if you're on the subcontractor's policy as additional insured, it does not give you rights to make changes to the policy. It doesn't give you rights to cancel the policy. It just affords you additional coverage for vicarious liability. And we see this required, like I said, by lenders, utilities, project owners, developers, and the like. You may also require it from your suppliers for their product. Getting away from sort of the stock property and casualty side, which is the property and general liability. In the construction phase, there's also professional liability, which is key. This is typically purchased, most people think of it as coverage for engineers. And we have a lot of conversations with folks in this space who say, we're not stamping anything, we don't think we really need it. But even if you're not stamping anything, if you're not an engineer stamping anything, you can still be held liable for financial loss. So errors and omissions or professional liability doesn't cover bodily injury or property damage to a third party. It doesn't cover property damage to your property. It covers a financial loss to a third party that arises out of your work. So if you make a mistake, so errors and omissions. So if you make a mistake in a design or a calculation, even if it's not a structural issue, you can be held liable for a financial loss. Some of the key exclusions that we see, I mean, the top one is efficacy. Efficacy is guarantees of performance. So if you have in your contract certain uptime guarantees, your professional liability would not cover if it fails just because it doesn't meet the performance. Now, it might cover you if it fails because you made a mistake in your calculation, you cost your client money, but it's not going to pay out just in the absence of performance. There are other insurance-backed financial instruments that can be purchased for that, but a professional liability policy isn't to be relied upon to backstop a warranty or performance output guarantee. The other general exclusion would be the professional services outside of the scope of work noted on the application. So just because you purchase a professional liability policy doesn't mean you're covered for everything. If you change some of the things that you do, so say you're, a solar designer and you decide to get into wind or batteries, but you don't tell your insurance company that you're shifting gears into a different technology space, you could find yourself without coverage fairly quickly if it's not broad as a definition. So making sure that if you were investigating going in a different direction from a professional perspective, that you talk to your insurance broker and insurance company first to make sure that understand the implications of coverage and cost. There are some things that could be outside of the scope of what your insurance company is willing to cover. So making sure that they're aware of what's happening and doing it ahead of time is always prudent. The other thing to note that we see and often write into contracts is a requirement of a tail policy. So a professional liability policy, and this is maybe getting into the weeds a little bit, but it's important. A professional liability policy is what we call a claims made and reported form, which means that the coverage in place at the time of the loss is the one that responds to the incident. And so if you stop carrying your professional liability policy today and you have a claim that comes up next week from work that you did 2 years ago, you don't have coverage. Um, Unfortunately, that's just how the coverage works. So the way we get around that, because oftentimes if there's a design error or omission that causes a financial loss, you don't find it right after you did the work. You find it 2 years later, 6 months later. And so typically what we write in is a requirement for what we call a tail policy or an extended reporting period, which means that if you decide to cease operations, and you want to cancel your policy, you continue on that coverage for anything that you did, any work prior to this date. You continue that coverage for typically it's 2 years, 2 or 3 years. Sometimes it's out to six. Statute of limitations is typically six. So we have seen it as long as that. but the prudent timeline would be 2 or 3 years at a minimum. And then when we're looking at limits, as I mentioned before, I mean, professional liability can be a really difficult thing to evaluate from an exposure perspective. Oftentimes in contract, if you're doing design work or you're in an engineering capacity, the limitation of liability is capped at the lesser of damages or fees paid to the engineer. And I can tell you that fees paid to an engineer for work done can be a couple $1,000s, but the exposure can be in the millions. So if you have a structural engineer who comes out and does a structural review and you pay, say, 7,500 bucks for that structural stamp structural drawing, and then it turns out that that structural was incorrect, if they're only responsible or liable for $7,500 and you've got a building collapse or it's a ground mount and the solar farm itself collapses under weight of ice and snow because it was designed wrong, the limits matching the fees paid would never work. So typically we're seeing things in the neighborhood of 2 to 5 million on the average um, rooftop solar design type work. Um, Sometimes you'll see higher limits. I've seen upwards of 30 million required in some cases if you're doing something that's really high value and the exposure is high, or if you're working with a counterparty that already has a risk manager and they've evaluated what they expect that risk exposure and what their risk tolerance is. So there are cases where it can get quite expensive and sometimes be limiting. We usually get a lot of questions about who is typically liable for what. Everybody is typically liable for something in the process of constructing anything. We see, the building owner, if it's a rooftop solar, if we're using the case of rooftop solar, it's a good example, I think, for this group, then the building owner would be responsible for covering the value of the building. So the underlying building, any rental income if they have tenants, any bylaw upgrade costs that may come about if there's an actual full limit loss. And of course, making sure that they have their own liability limits, and that they're also requiring their subcontractors to carry appropriate liability limits. One of the best examples of that is a building owner employing a snow removal contractor, and that snow removal contractor bearing a transformer with snow. Making sure that there's enough liability for the property damage to that system is really important. And making sure that if there is anything that happens in the course of construction, if an HVAC contractor needs to get on the roof while you're installing something, ensuring that HVAC contractor has insurance, even if it's a contractual requirement with the building owner, that means the building owner is liable for making sure that they have it. So that contractual relationship is clean. The builder's risk or installation floater, of course, for replacement of the system being installed on the building. That would be the contractor and or subcontractor, depending on how that's structured. And of course, making sure that the liability limits that are reflective of the total loss of a third party building and potentially the contents and loss of profits. We've seen some instances where solar arrays didn't get built on rooftops because the requirement for liability limits was just too high. Back in fit days in Ontario, I'll never forget it. Wood frame warehouses with whiskey in it. Hundreds of millions of dollars of whiskey. So if you think of things that are flammable and that would continue to burn, that was one of the worst profiles of a risk that I have ever seen. And I believe that that never got built because the cost of insurance alone was too great, not just for the construction portion of it, but also for the operational of it. The structural engineer and anyone doing design work really should carry professional liability limits, and you would want it to cover the loss of a structure. And then, of course, maintaining a tail policy or extended reporting period once their operations cease. Or the other way we've seen the language is 3 years following the completion of the work, or for no less than 3 years following the completion of the work. And then all parties, of course, would include indemnity and insurance provisions in the contracts before the work begins. So making sure that everybody has the appropriate insurances as set out by all the contracts, and that any of the contracts that you're undertaking that may have flow-through requirements for subcontractors or counterparties, making sure that all of those clauses is pushed down through your own subcontracts. And making sure that you have contracts with your subcontractors is also key. Just having insurance isn't enough. Just having proof of insurance isn't enough. Making sure that there's a contractual relationship and not just a handshake. I think the renewables industry has gotten to a point where we're no longer a grassroots number of organizations shaking hands and trying to do good things. There's a lot of folks doing business in this industry, and everybody's friends until something goes wrong. So having a contract will certainly help. It's kind of like a prenup, but for business, and I recommend it for everybody. And of course, making sure that the certificates of insurance are kept on hand, and of course, additional insured status is noted. If you simply get evidence of insurance and you're not noted as additional insured where you need to be, you can't simply go through the insurer to get indemnified by their policy. It can create significant challenges both during work and after work should something arise post construction. And then some of the other coverages that we get involved in, these days, we're focusing a lot of our efforts on battery systems and performance and warranty insurance coverage. So insurance-backed financial instruments aren't necessarily a standard insurance policy. They can go out well longer than a year because they're intended to cover performance. Typically, performance of a system can be the whole design and installation. It could be the manufacturer's product. Think solar panels with a 30-year performance guarantee and a linear degradation, wanting to make sure that there's some insurance behind that for the length of the warranty period has become something more consistently required by lenders and counterparties. Again, especially on things like batteries that we're seeing these days. So these policies are typically structured around 5 to 10 years, with the exception of solar performance on the modules, and that we can get out to 25 years. This typically provides a bankability backstop for either the manufacturer, depending on who's purchasing for what, or the design and installation company if it's wrapping the full system. And that way there's only one source of warranty obligations. We saw an uptick of this after the Powen situation occurred, whereby folks were really concerned that they weren't going to be able to call warranty in the event that they had some issues with their systems. And this is publicly available information. So we've seen a huge uptick in the requirement for that, and we can even place insurance and warranty coverage, I should say, on systems where there is no longer availability for warranty from the supplier or the manufacturer. We often get asked what goes into pricing these types of risks. I mean, nobody really wants to pay for insurance. That I understand. It can be kind of a nuisance. In the last couple of years, although the last year has been much better from an insurance cost perspective, we were in a hard market and things were very expensive. And so there's been a lot of questions around, what do I really need to carry? What are the key risk factors I need to consider when looking at my insurance placements, and how should I go about placing my insurance? So some of the key risk factors that you'd expect is, what is the system type and technology? Is it rooftop or ground mount? Is it fixed does it track? What is the underlying structure type if it's roof mount, like if it's a wood frame, if you're installing on wood frame, barns or residential houses? We see more small claims on the residential houses than we do pretty well anywhere else. So just something to keep in mind when you're looking at the business that you're in and making sure that the insurer is good with what you're doing. The geography and cat exposure. So cat refers to natural catastrophes. So we're really paying close attention to hail zones, wind, flood, wildfire proximity. Of course, in the BC area, wildfire and quake are a big concern. So seismic zones, and then looking at rate and deductible structures. So where you're exposed and the value of the installation, if you're doing large scale, like utility installations, making sure that you're working with your insurer early on where this is and how you're constructing. I don't know if anyone on the line is doing any work in the Caribbean, but the other thing to note is if you are doing work in the Caribbean, 'cause we've got quite a few Canadian folks that go down there to do solar installs, understanding the nuances of constructing in hurricane season and avoiding hurricane season is really important. There are some clauses within policies that, even in the Canadian policies, there's sometimes clauses before you bind that you can only bind coverage if there's no wildfire within 50 kilometers of the location for which you're installing. So the insurers are paying close attention to natural catastrophe. They have certainly been burned by natural catastrophe and paid significant losses here. So they will pay close attention to where you're installing and what you're installing. And then if there's any, if you're doing a big build out and you've got some solar farms that are exposed to hail and you're expecting to operate, understanding if you're tracking in Alberta, making sure that your track and stow procedures work, even if only part the farm is partially complete, is just good practice. Looking at the installation and O&M quality, so certified installers, engineered stamped drawings, some of this is table stakes, documented O&M agreements, and qualified service providers for sure can improve underwriting outcomes. The one thing I always say about underwriters is that they always look at the worst case scenario and then they work their way back based on the information that they've been provided with. And so if someone hands them a risk and says a solar farm in Alberta worth $100 million, without having any other information, they will think worst case scenario. You'll get $500,000 hail deductibles. The more information that they understand about mitigations that are being undertaken in the installation process, the better. And as installers, your end owners will be coming to you asking a lot of this information as well so that they can price out their own operational insurance. So don't be surprised if you get asked for details or to fill out an application for an end owner that details some of the mitigation things that you're doing. Maybe there's a flood issue. Um, Oftentimes we map things where there's partial location is flooded. So understanding if, are you putting your I houses in the low-lying areas or are you building up with crush and appropriate runoff measures? How are you grading the site? Like those things are all really important, especially if you're looking at flood. If it's wildfire, making sure that there are appropriate setbacks. What the vegetation management looks like is going to be key, even in the course of construction, if you're doing large sites. Again, anywhere that's wildfire or prairie fire exposed, those things are really important to understand. And we've seen losses happen within the installation where you've had flood risk. People have stored panels on the ground in low-lying areas and they've ended up underwater. So certainly things to be mindful of where your laydown areas are, things like that. Contract structure and claims history. So one of the things that we've been doing over the last, I'd say, 3 years is talking to a lot of end owners and municipalities, anyone who is looking at installing or engaging EPCs to install solar, and getting them to ask for loss runs. So a loss run is what an insurance company will provide that shows the history of a company that's insured and the losses they've incurred. And it is really the only true way to know or to understand and evaluate certain types of quality. References are great, but understanding if there's been any liability claims against a contractor is also really helpful. And we've sometimes seen it come up in RFPs where it asks if there's been any litigation, if the contractor has been involved in any litigation. You'll likely start to find that that language has shifted to requesting a loss run because insurance claims aren't necessarily always stemming from litigation. They sometimes do, but sometimes it's simply a written demand, a root cause analysis, and maybe it's a subrogation. So, um, contract and structure and claims history all matter. Who's responsible for what indemnities that you're taking on and what you're offloading. So are you keeping environmental indemnities or are you pushing environmental indemnity off to, say, a subcontractor that's doing site grading? We've seen pollution events and claims come up where a solar farm was built on rolling hills and there was a water event. The site wasn't graded properly. Silt ended up in a nearby farmer's pond, and it was $4 million worth of cleanup. Making sure that the environmental indemnity is in the right place is key, among other indemnities. And of course, looking at who's responsible simply for what, even in the supply agreements um, for the equipment that's being provided. So making sure that you understand who's responsible for what when. Are you responsible for when it hits site? Are you responsible for the inland transit? Are you responsible for when it leaves the manufacturing facility? And then there might be some ocean cargo requirements. So understanding those things is really important, not only to evaluate the risk, but also to make sure that you're structuring the right insurance. Um, and having brokers work with your legal team to look at your contracts to make sure that you're not taking on anything inappropriate and offloading things where appropriate and where you can is something that teams like mine can certainly assist with. We get pretty heavily into the contracts a lot of the time, like outsourced risk managers, to make sure that everyone's got the things that they need, and if there needs to be pushback within some of the confines of insurance and indemnity, we can certainly help make that case. Claims examples. These are just a handful of some of the claims that we've seen, although I can say that the list is longer than my arm. Theft and vandalism is certainly something that we've seen, especially in rural and remote locations. We've seen theft of rooftop system components and vandalism. This would be typically covered under an all-risk property policy or builder's risk policy if it's still in the course of construction. Structural failure or design error is typically covered under professional liability. So structural losses from errors in a weight load calculation in the design is one, but we've also seen claims where we've had a design of a system that was didn't take certain shading into consideration from HVAC equipment, so roof furniture having impact on the design, or ballast systems not necessarily being enough. And if you don't have contracts in place with your subcontractors and your engineers and the folks doing this due diligence, you can find yourselves uncovered for some of these liabilities and on the hook for those. So making sure you understand the value of having contracts with your counterparties, the value of making sure that it's not just a purchase order that you're signing, that there's proper contracts in place that outline who's responsible for what, who's liable for what, is really important. Wind damage is another good reflection of some of the claims that we've seen, especially as the climate is shifting and we're starting to see wind gusts higher than we've seen before. Building code typically struggles to keep up with these changes. I know there's been some recent changes in Ontario. I think a year and a half ago, there was a structural shift to the requirements, structural weight load capacity requirements in Ontario. Um, but it's always kind of behind the eight ball. Insurers are always a little behind the eight ball too, but I can say codes and standards are generally slightly behind. And so we've seen some losses where everything was built to code, but a system flipped off the roof because there were gusts that we just hadn't seen before. So paying attention to designing for future resilience is something that we recommend on the insurance side. I do understand, though, practically speaking, that cost is a consideration. And so that doesn't always work from a cost benefit analysis, but something that we're really looking at taking a good hard look at is how things are constructed with resiliency in mind. And I think a lot of encouraging a lot of building owners to pay a little bit extra to make sure that their installations are that much more resilient. Component failure. We see failure of manufactured parts like inverters, modules, and racking. So the equipment breakdown portion within either builder's risk in the testing and commissioning stage or on a general property policy will respond. What isn't covered in the confines of that, if it's a failure of a part, is the cost of making the defective part good. So if there's an equipment breakdown and ensuing fire, the fire is covered and the rest of the equipment would be covered under the fire loss, but the defective part itself, if there is a defective part, would not be covered. And then fire damage. I mean, that's a pretty standard inclusion within a property policy. So if there's a fire at the installation, as long, subject to the cause of loss, if it's not arson by somebody who built the project or the building owner, typically those things are covered. Losses that are not covered, this is probably more important to understand is where things aren't covered and where you're taking on potentially business risk and how you can look at mitigating them. So this is where we've seen things fall outside of standard coverage. Vermin damage, for example, chewed wires cause fires. We have lots of squirrels in Ontario. And squirrels love making nests in warm places, like underneath solar arrays. And there is a vermin exclusion under homeowners policy. So any damage howsoever caused by vermin would be excluded. Typically, we see the mitigation as a wildfire deterrent system and, of course, regular inspections. This is something that sometimes gets missed, but at least biannual inspections of residential systems, although not always the most cost effective, is something that's really important to ensure that there's no issues within those systems. And they often get neglected because there's not a lot of money in it. Animals nest, that can also cause fires. Not just the chewed wires piece, but building a nest actually within the confines of a solar array can lead to overheating, and just cause issues with the solar array. They also having a nest underneath can lead to vermin not chewing the wires, but chewing through a roof. We've seen losses where squirrels actually chewed through the roof itself and into the attic and caused a significant amount of damage to the homeowner's attic. And it took 2 years for them to figure it out because it took 2 years for the water damage to get so bad that it finally was something visible to the homeowner inside the house. So just something to keep in mind. Wear and tear, helical pilings have been a bit of a challenge. Um, Notwithstanding wind loads, so it could be excluded under wear and tear if it wasn't put in properly. There may be recourse through the installation policy, also through the manufacturer. So we've seen some instances where racking itself was not designed to keep up with the snow load. And so we have seen a handful of collapses within the solar industry. So making sure that some of that is contemplated in the installation process, but general wear and tear wouldn't be something that would be included within a policy. And shading from an adjacent construction. So if we've seen this as well. It's not something that's claimable, but if somebody builds a building next to a building with solar and now it's shaded, there's no insurable claim there. If you have a quarry close by, the dust that settles on top of the solar panels is not covered as a loss. This comes down to where you're installing and making sure if you're on the installation and or O&M side that you're well aware of the surrounding areas and some of the potential exposures for lack of performance. If especially if you're contracted to do panel cleaning, one of the things that's come up in a handful of locations is additional costs of panel cleaning. So not just twice a year, needing it to be done 3 or 4 times a year because there's a quarry close by and there's lots of blasting and dust settling. This can also happen at certain types of farms and other very dusty places where there's excess soiling on the panels, and that's not something that's covered by insurance. There is performance guarantee insurance that can cover lack of sun. Lack of sun from wildfire smoke, lack of sun from volcanic ash, which has been a thing. And I will say wildfire smoke has had more of an impact than we ever expected in the Canadian market on solar performance specifically. But it's not something that's covered by insurance. Although fire itself is, the fire actually has to damage the equipment that's insured as opposed to just cause excessive shading due to either excessive cloud cover or smoke that comes in. And that's it. I feel like that was a lot of very insurance heavy information for you guys on a Wednesday.
Awesome. Thanks so much, Jen. I don't see any questions in the Q&A, so we'll just give a couple minutes here for anyone to type in their questions if you have any. But in the meantime, Jen, thank you so much for joining us today. Yeah, that was a jam-packed session full of a lot of information. Um, let's see here. No questions. Okay, it looks like your contact information is up on the screen there. So if anybody has any questions for Jen after, oh, here we go. We have one from Yitz. Is there a way to cover those items that were excluded?
Um, the ones that I've noted, not in the standard property and casualty, like vermin is just something that's not included. So no, there's no way to insure that. Um, there are some things that could be covered elsewhere, and oftentimes we offload those things in contract. So risk management isn't just about placing an insurance policy. Oftentimes it's about having a conversation about what the risks are that you're concerned about and being able to work through the different parties to the project and where some of those risks can either be offloaded to another party or maybe a separate insurance policy. So there are different insurance policies. There's cyber liability that we didn't get into. Surety bonding is something that we didn't get into, although we do have experts that do surety. Labor and material and performance of system surety bonding. So you can offload some of those risks. Environmental impairment liability is another coverage. So if there's a pollution event that is outside of the sudden and accidental nature, typically included in a general liability policy or a wrap-up liability policy, those things can be offloaded elsewhere. And sometimes it's just somebody else's insurance policy if it's not your risk.
Okay, we have a couple more questions in here. Would there be an insurance available for homeowners to insure their systems after it has been installed or project is completed?
Absolutely. Most home insurance companies have no problem insuring solar on the roof. Most of them are fine with batteries as long as they're installed to current code, and bylaws, of course. I will say making sure that the insurer is aware before the installation goes ahead is important because there are one or two that pop out every once in a while that won't insure it or will say they won't insure it based on size, but it might be incorrect. So sometimes you get a bit of a choking hazard on the home insurance front, which is frustrating and problematic. But oftentimes it can be solved with information. So if you run into a situation where a homeowner's insurance company is either balking at putting solar on their roof entirely, which every once in a while there's some random insurance company that has a problem with it, but most of them are fine, or there's a size issue. The size issue, I mean, you can have them call me and I can walk their broker through it and just try and make the problem go away. But the size issue stemmed from the Ontario feed-in tariff and the size of microfits. And so for the longest time, the entire insurance industry in Canada limited residential solar to 10 kilowatts. Now, I will say the ones I've worked with and others that are direct writers like cooperators, we've worked with to get them to increase that limit to 50 kilowatts. I don't know any houses that would need more than 50 kilowatts on their roof or would fit 50 kilowatts on a roof. And if they're that big of a house, they're probably insured with a high value home insurer and they probably have no problem with the solar being added. But every once in a while, we do run into those types of challenges, and often it's really just an exchange of information to make sure we get them on side. Every once in a while, it results in them changing the insurance company, and sometimes, not very often, it results in them not going ahead with an installation. But better to get ahead of it because the last thing you want is them getting a 30-day notice of cancellation after it's been connected and installed, and then panicking that they can't get insurance for their house.
Thank you. We have another one here from Alejandro. He says, "Thank you for the presentation. You're right. This was quite a lot of insurance lingo, and he tried to keep up. But he's wondering if you could quickly summarize two or three key actions that he can immediately take to check that his coverage and structuring of insurance is sufficient. Do you have any tips?"
Uh, oh man. I call your broker or call me and I can look at it. It's probably my
Perfect.
easiest answer. Just send me a copy and I'll we can set up a call and have a conversation about what you're doing, what your exposures are, and how things work. And it doesn't take long and it doesn't cost anything, so I'm happy to do that.
Wonderful. Thank you. Okay, that was all the questions in the Q&A. Jen, thank you again for joining us. For everyone on the call, this recording will be uploaded to our YouTube channel later today, and I will also send it out in an email to you. So thanks again, Jen.
Thanks.
Take care.
You too.